Will inflation send commodities higher? Welcome to Real Vision Daily Briefing. It's Tuesday, May 7, 2024. I'm Ash Bennington, joined today by Doomberg, head writer of the Doomberg Substack. Welcome.
Hey, Ash, great to be here. I got to say, crosses off a key item on my bucket list to be interviewed by Ash Bennington on Real Vision. I mean, who could ask for more?
Doomberg, I feel exactly the same way. It's like, longtime listener, first time caller. I've been watching you on Real Vision, and it's just a pleasure to have you here and to have this conversation with you today. Before we get into the weeds, I want to, since this is your first time having a conversation with me, let's start at the 50,000 foot level and talk a little bit about the way you currently see energy markets, big picture.
You bet. So we like to say the single most important thing a macro analyst should answer to themselves is the global market for primary energy well supplied or in short? And if it's long, that informs a certain set of views. And if the energy markets are short, supplies are tight, commodity prices are high, that informs a different set of views. And if we look across the primary energy spectrum today, we see coal trading between $125 and $150 a ton, which is relatively affordable, let's say, compared to historical averages. Natural gas in the US is in the middle of a glut. You can't give it away in some parts of the US, which we'll probably talk about. And the one primary energy input that stands out when you correct for energy content, when you sort of normalize dollars per million BTU, is oil. And oil is trading at a relatively substantial premium to the other primary energy commodities. And two things you should sort of ask yourself about that is how can you estimate that premium, and what is the genesis of it? What is the source of it? So our preferred view to try to get a thumb in the air estimate of the geopolitical risk premium in oil is to multiply landed natural gas prices as quoted in dollars per million BTU by 6 and compare that to WTI and Brent. And if we look today, natural gas landed in Europe or in Asia is about $10 a million BTU, which makes it roughly the equivalent of $60 a barrel oil. And we see WTI trading around 80 and Brent a little higher, which means some portion of that $20 to $25 difference is as a result of we think the ongoing kinetic conflicts, both in Ukraine and in the Palestinian, Gaza, Israel, Iran nexus. And in our view, if peace were to miraculously and spontaneously appear, we think oil could easily head south of 60 and below, because we do believe at the highest level, commodities are pretty well supplied. You have, OPEC holding back a couple million barrels a day of production. Interesting to see how that discipline maintains itself as things progress. But by and large, there's plenty of natural gas in the world. There's plenty of coal in the world. In the physical markets, there seems to be more than enough oil to be had. And the only real standout metric that we see on the board today is this geopolitical risk premium in oil. And so we view the price of oil as a proxy for the market's assessment of risk of the war expanding. And that's our view today.
So let's take that view and talk a little bit about how you express it in terms of positioning. WTI, I know, is something that folks here at Real Vision watch quite closely. I think most people have a rough idea of what that chart looks like. Heading down to essentially zero, below zero during the depths of the pandemic in the spring of 2020, shooting up during the reopening in May, June, July of 2022 to just shy, I believe, of $120 a barrel. Now trading on my screen, 78.45. Talk a little bit about how the thesis intersects with price and how you think about expressing.
Yeah. So the sweet spot for oil. Look, oil is not a freely traded commodity, right? I mean, we have like an overt cartel that has an expressed desire to help manage the price. It is highly inelastic, so 1 million barrels a day or 2 million barrels a day of supply swing can radically change the price, as we saw when it traded for minus $37 a barrel at the height of the COVID crisis, because we're basically running out of places to put the stuff, and traded up to $130 a barrel. I think Brent touched at the apex of the initial outbreak of war in Ukraine as a result of Putin's invasion of that country. And so Another example is President Biden released 1 million barrels a day, 1% of global daily demand for a period of 6 months, and he cut the price of oil in half. That gives you some indication of the sensitivity of the price of the commodity with respect to supply deficits for supply excesses. Um, and so the sweet spot for OPEC is between $70 and $90 a barrel today, which on an inflation adjusted basis back to like $1980 is $25 a barrel. I mean, oil is still incredibly cheap today for all the talk of peak cheap oil and all that nonsense. There's plenty of it, and it's dirt cheap considering its utility for humanity. So $70 to $90 a barrel is where OPEC would like to manage the price. Anything below that, and they begin to see budgetary stresses, and anything above that, and they begin to concern themselves with economic contraction and inflation causing pullbacks and things like that. And so we're kind of in the middle of that sweet spot right now. I think when we saw the initial reports that Iran was lobbing a couple hundred missiles and drones into Israel, you saw oil spike. And then when Iran preemptively said, even before the missiles had landed, that this was the end of their conflict in their view, oil prices collapsed and gold prices collapsed, and so on. And so the one thing that we need to keep an eye on as investors, whatever your views on positioning, is Biden's extreme attention to the price of gasoline in the U.S. He's an old school politician. We personally interacted with his staff when he was the senator from Delaware, which we used to jokingly say, Joe Biden, D, comma, DuPont. He knows the commodity industry quite well. He's acutely aware of the price of gasoline at the pump and how that affects the future runway for politicians. There's talk just today that they might tap the SPR again, the Strategic Petroleum Reserves, to try to manage oil prices down ahead of the election. And so when you look at the fact that oil is trading at a substantial premium to the other primary inputs, and the president would like oil prices to go down, it sets up sort of a short-term scenario where we view the risk to be on the downside. I will close by mentioning a new Substack author, Jack Johnston, who's a really great commodities trader, and I think he's retiring and now starting to write more broadly on Substack. Had a really great note this morning. JJ745, I believe, is the Substack handle, talking about how the risk of 60 seems more likely to him than the risk of 90 or 100.
Do you share that view,
I
Doomberg?
do. Yeah. Yeah. I think, look, if we could broker a ceasefire in Israel, and the Russians reach the Dnieper River, and hostilities come to a close there, and we have some form of a North Korea, South Korea situation where the West claims that these borders haven't moved and Russia's just going to occupy the place and dare somebody to do something about it. I think we could see downside risk to the price of oil. And on top of that, look, when you have natural gas trading for as cheap as it is, and we should say Henry Hub has since recovered off the lows, which we had thought might have been in at $1.50 per million BTU Henry Hub, but just last week there was a pipeline, Kinder Morgan pipeline declared force majeure, and the price of natural gas at the Waha Hub in the Permian Basin is minus $4 per million BTU today. Million BTU today on the screen as we're talking. That's a spot price, of course, but they're giving away natural gas in the beating heart of the U.S. Oil and gas and commodity infrastructure in Texas, and that is eventually people will just switch the engines. Like, they're not going to burn diesel with WTI at $80 or $78 as it is today, when they can burn natural gas and do the same work at a fraction of the price. And so the markets will close that arbitrage over time. In a glut, arbitrages tend to close down. In a supply crisis, arbitrages tend to close up. And we have so much natural gas, especially in the US. And the thing that people perhaps don't understand is that the production of oil and the production of natural gas are linked in the US. And so this geopolitical risk premium in oil is driving the glut in natural gas because it is co-produced, especially in the Permian, as an unwanted byproduct. And you can't give it away. The reason why they're paying people to take natural gas in the Permian is because they want to sell that oil for $80 a barrel because that's above their break-even price or their profit zone. And so perversely, war will eventually be the undoing of that energy arbitrage when you correct for content.
This is so fascinating for me, Doomberg, because I'm barely a tourist in this space where you are a permanent resident, but it's fascinating to me and it's really interesting. I want to talk about natural gas in just a minute, but I also want to ask you something about something because it's generally in the news for political reasons. You mentioned the SPR, the Strategic Petroleum Reserve. I am, again, just a visitor in this space, but I'm looking right now on the EIA website. This is the US Energy Information Administration at the SPR Reserve stocks. And what I see here is a peak, it looks like around 2010 at just shy of 750,000 barrels, staying relatively constant, rolling down in 2020 to maybe 630,000 barrels. And now we've cut that in half since President Biden has tapped that. What are the risks in doing so if we get below, say, 250,000 barrels?
So need to correct you by 3 orders of magnitude. It was 3/4 of a billion barrels of oil, and now there's some 300 and change million barrels of oil.
All right,
People,
it's expressed in thousands. This is how you
yes,
know
yes,
I'm a
yes, yes.
tourist.
Well, actually, Bloomberg has this crazy. They express it in thousand barrels, but then the chart is in millions. So it's 0.365 million thousands, and I don't know why they just don't say 365 million. But
I can't, Doomberg. I can't imagine
yes.
why I would be confused.
Exactly. But nonetheless, one of the things that people need to realize about the Strategic Petroleum Reserve is it was constructed as a consequence of the supply crisis as a result of the oil embargo of the 1970s, the Yom Kippur War. And back then, the main US political establishment thinking was that Herbert's peak was right and the US had reached peak oil production. It was already a major importer of crude and would forever be. And what has changed in the intervening period is the shale revolution. So we built and filled it when we needed it because we were net energy importers and by a wide margin. But the shale revolution has made the US a gigapower in energy. We produce 20% of the world's oil and petroleum products. We produce 30% plus of the world's natural gas. We're still a net exporter of coal. We have some 95 nuclear reactors operating with really great capacity factors. We have an abundance of food and fertilizer and the ports to export them. We are a superpower in energy today, unlike the world has ever seen. I believe, and I quote Luke Groman in this regard, that we've added 2.5 Saudi Arabia's worth of BTUs since the advent of the shale revolution. And so
Is that total energy production capacity, including natural gas?
yeah, gas and oil, 2.5 Saudi
That's on like a
Arabia's.
BTU normalized
Yeah,
basis.
exactly. And then, by the way, unlike most petrostates, we have a relative, still, despite China's best efforts to hollow it out, we have a relatively robust manufacturing sector that can feed off of that natural gas and do quite well for themselves. You know, if you're a fertilizer maker in the U.S. who gets to price your product on in the global markets, you're pretty happy to have somebody pay you to take natural gas so that you can make your fertilizer. Whereas, you know, if your competitors are paying $10 a million BTU for landed LNG, then you're going to win in that market. You know, you're going to climb the cost curve quite well. So when the SPR was built, we needed it, and we were short, and now we're long. We're net exporters. We have more refining capacity than we need. We're net exporters of refined goods like gasoline and diesel. In parts of the country, we still have to import because of various insanities like the Jones Act, which doesn't allow us to like ship, you know, diesel from the Gulf Coast of Texas to New York because unless, you know, it's a U.S. flag ship, and we don't have any such ships because we're not in the marine business anymore. But nonetheless, we have this abundance of energy in the U.S., and so it seems reckless. It is certainly political, like it's overtly political. So I can understand why people who might be Trump supporters think it's a dirty deal for Biden to empty the SPR ahead of the midterms to save a few House seats and now ahead of the presidential election. But he's going to do it. And on the pantheon of risks that the U.S. is taking, that's relatively small compared to the fact that we've allowed, for example, China to hollow out our manufacturing sector, especially in the military supply chains. In fact, we in our Doom Zoom presentation for our Pro Tier this month, we half jokingly called China the new arsenal of democracy because all democracies have outsourced their military supply chains to China, and we just assume they'll keep giving us these critical goods when we go to war with them. It's insane. But I digress. The SPR will be emptied ahead of the election if Biden needs it. It will be overtly political, and it'll work. It will swing a few percent of voters because people care about the price of gasoline.
But interestingly, what I hear you saying is compared to the other risks that you see in the economy around energy, around supply chains, and elsewhere. You believe that the new supply dynamics in the United States makes emptying the strategic petroleum reserve, though it is, in your view, an overtly political act, far less dangerous than it might seem on the surface because of the productive capacity of the energy sector in the United States.
Correct. I mean, again, if we were net oil importers and we were at the behest of the Saudis, it would be a different story. Now, look, if you're Europe, you're still in that situation, but Europe has got its own insane energy policies to deal with. The U.S. is an energy gigapower today. There has never been a country more powerful, more prolific from an energy perspective than the United States of America in 2024. Period. And that has to be the first input into geopolitics, into economics. One thing that like puzzles us. We wrote a piece early this year called "Slick Landing," where we predicted that it would be highly unlikely that the U.S. would slip into a recession, and we tried to explain why we thought that was. We all know that if oil goes to $150 a barrel, we're probably going to see a recession. In fact, last time it peaked out in that range, we saw the great financial crisis of 08, 09. We also know that if oil spikes to $150 or $200 or $300, we're going to see inflation. And we also know that Germany screwed up its energy policy and it is undergoing massive deindustrialization and struggling with a recession. Why would it not be then that the exact opposite of those things? We're swimming in cheap hydrocarbons. We can't give away natural gas. We produce more than enough of the oil that we need. We're net exporters of coal. We have the world's best nuclear and largest and best nuclear power fleet still until China laps us. Why wouldn't it be that concoction would be something that might insulate us against a recessionary impulse, especially when you have Congress wastefully spending so much money and running these large deficits, and you have an overtly political Fed that has an eye on the election, and everybody in Washington, D.C. wants to keep the orange man out of the White House. Like, how is this a recipe that's going to bake a recession cake? I don't see it. We don't see. We made the call. We'll see. If we're wrong, we'll try to figure out why, and we'll admit it. But I think lots of people have a political lens when they try to view sort of macroeconomic numbers. They want Biden to fail. They want oil prices to go up. They want gasoline prices to go up. That's just not in the cards. Like I just don't see it. You have to be the difference between an analyst and an advocate is you try to read the numbers on the screen and do your best to interpret them. And that's our view. Look, we came to some prominence during an energy crisis, but that doesn't mean we're permanent energy bulls. Like the very most important question you have to ask is, are we short or long energy? And the very nature of that question is there are two possibilities. And once you convince yourself of one or the other, you have to go with it. And we think the world is long commodities today.
Gosh, that's so well said. Advocacy just seems like it's bleeding into everything in 2024 on both sides of the aisle. And it's a real challenge. And it's one of the reasons why we're so happy to have you here on Real Vision to cut through a lot of that noise. By the way, Doomberg, before we move on to the next segment, I wanted to give you the opportunity. You mentioned the Pro Tier. Tell folks if they're interested in hearing more about what we're talking about right now, where they can find you, where they can find your content.
Sure. All our work is at Doomberg.com. We recently ejected a squatter from that domain name at no small cost. I suppose that's a compliment that we had to pay up to get rid of said squatter, and they made a good investment. But we're now Doomberg.com. We're still a Substack site, and we are partners with Substack. We have two tiers. We have an annual subscription tier where you get all of our articles and you get to comment on all the pieces and interact with us. And then also we have this Pro tier for perhaps wealthier or even some people who work on Wall Street to get additional access to Doomberg. And that tier also gets a monthly webinar from us, either a presentation we put together or a high-profile guest. And so those are the two tiers we have. But basically, this is the work of our lives. We publish 7 or 8 pieces a month and one Doom Zoom a month, as we call it for our Pro tier. And this is all we do, and it's really a blast.
I can't even imagine publishing 7 or 8 pieces a month.
We were joking before we went on the air. We're a very small team, but when you find what you were meant to be doing in life, you just keep doing it. And these pieces just sort of come to me, and then we research, write, edit, publish, promote, defend all of them. And sometimes we're wrong, and we admit it, and we learn, and we have this amazing network. We're approaching 230,000 subscribers on the Doomberg platform, which means we have this vast network of experts to tap into for ideas and consulting on pieces as we're working them. And this person that I know works in the utility industry, and they're very senior position at such and such a company. Let's reach out to them off the record and find out whether we're characterizing this right, and so on. And then we have a cascade of really interesting story ideas coming to us every day via email, and we try to respond to every subscriber. And so it's just really fun. Again, like when you find what you're meant to be doing, good Lord, just keep doing it. And that's our plan. And so back to the whole advocacy versus analyst thing. Look, an energy crisis would be great for Doomberg, as measured by our subscription business, for example. We're not cheering for an energy crisis. We are trying to analyze the markets and call the balls and strikes as we see them, because our goal is to still be doing this in 10 years, right? And the more credibility you build with your audience by calling it as you see it. And look, we get things wrong. We were early to the European energy crisis, and we hung on to that thesis too long. But then we were pretty quick to call the coming glut in natural gas, which I think we got right. And we were certainly dead to nuts right on the sanctions policy, and that it would backfire. And so we've gotten some big calls right. We've gotten some big calls wrong. Nobody bats 1,000 in this business. And as one of our subscribers who appreciates our authenticity and our analysis said to us, the only thing worse than being wrong is having no opinion. Give me your opinion, show me your homework, and I'll do the rest. And so that's our view.
Very well said. Talking of which, I want to take a look at another view. This is Andreas Steno Larson, and we'll talk about his view when you get back. A piece called What If the Fed Holds Rates Steady? This is from today, 5/7/2024. Let's take a look at that clip.
When you see such a decline in the input price of everything from energy to chemicals to food, you typically see a tendency towards increasing order books because of falling prices. So basically the opposite of what an economic textbook will tell you. But what happens when prices decline is that a lot of people assess that this is a good timing to buy and load up on inventories. And that's essentially what we're seeing the first signs of now. And if I'm right, that's a very positive sign for the overall commodity cycle during the rest of the year. And when we pair that real world reflation or inflation with easy financial conditions, I still think financial conditions are pretty easy, especially in the US, we probably still have an inflation problem down the road.
Doomberg, I think you may have a slightly different view from Andreas Steno Larson. Let's give you a chance to respond.
Sure. First of all, a big fan of Andreas. Love his work. Always try to catch him when he's out there, and I watched that clip with interest. I think one thing that's really important for people to differentiate is you might be in the commodity sector, but you are either a producer of commodities or a user of commodities, and where you're drawing that commodities line. So if I look at that chart that Andreas showed, the chemical industry, for example, which is one we know quite well, they are in the US benefiting greatly from cheap natural gas. And so, of course, global investment is going to come to the US and perhaps stay away from Europe or Asia, because we have this natural gas advantage, and that is a key input into the chemical sector. The chemical industry is dotted with cogeneration facilities. The two things you need to run an integrated chemical plant like BSF, or pick your favorite, is you need electricity and you need steam. You need industrial grade heat, and you get both of those from a natural gas fired power plant. And so if you're a producer of natural gas, you're in the commodity sector. And if you're in the chemical industry, Wall Street investors think they're in the commodity sector, but in reality, they are benefiting from this natural gas glut. And so you always have to ask yourself, when you're analyzing an industry or a stock or a company, what are their inputs and what are their outputs? What are they paying for their inputs? What do they get to charge for their outputs? And so if you look at the fertilizer companies, like we mentioned earlier, like you want to be in the US today if you're making fertilizer, because fertilizer is a globally traded commodity. Fertilizers are globally traded commodities, and your inputs basically are natural gas. And so if you're at $2 a million BTU Henry Hub, but you get to charge ammonia global prices out of Tampa for export, you're going to be printing cash, like literally a license to print cash. And if you're an ammonia producer in Germany right now, you're in the hurt locker. And so I think you have to drill down into regions and integration. So how back integrated is this particular company? And broadly speaking, is the fertilizer industry in North America better situated than the Chinese? Take Mexico. Mexico has a huge advantage right now because it has hard pipes overland to the Permian, and they're getting natural gas in abundant supply at dirt cheap prices. And if you're looking at the power sector in Mexico, or you're looking at the chemical industry in Mexico, or you're looking at the automotive industry in Mexico, which is a great consumer of electricity and energy, you can see that when you have this dirt cheap natural gas plus access to the North American market via NAFTA, and then you have this foreign investment because of those two factors, you could see and begin to understand why it is that despite the challenges with sort of the Mexican government and the drug cartels and so on, that we're seeing this boomlet in Mexico. And so and the last thing I would say is I think commodities drive inflation, not the other way around. And so back to our original question of are commodity markets well supplied? If they are well supplied, that's generally not it's a headwind for inflationary spikes. If you have negative natural gas in the Permian Basin and you have oil relatively well tamed and coal pretty cheap, this is not conditions that are ripe for inflation, with the big exception of the shipping issues in the Red Sea and other hotspots and so on, and that would certainly drive some inflation. But in our view, commodities lead inflation, not the other way around.
Gosh, Doomberg, I would love to have you back for a full hour deep dive just to hear you talk about the natural gas business here in the United States. That would be fascinating.
Anytime. 2
I'm gonna
hours.
I'm gonna take you up on that, man. That would be awesome.
You bet.
That would be fantastic. All right, let's see if we can do a speed round here. We got a lot of questions coming in. Let's just see if we can hit as many of these as quickly as we possibly can, because I know that folks want to hear from you. First one comes from Nick C. Hi, Doomberg. Part of Raoul Pal's thesis is that we will have to move to more nuclear or have innovation in the energy sector to be able to supply the energy needed to support the new demand that AI will need. What companies, where are you looking for innovation in the energy sector? Great question. Where are you looking for innovation?
So first of all, I agree wholeheartedly. We've written about this quite favorably. One of the best titles of our pieces, which was supplied by Grant Williams, called Fission Ships. We believe that the need for both increased electricity and quality of electricity makes nuclear power uniquely situated to supply that increasing demand. We have this view that the sort of Kurzweilian computing exponential growth curve will always be hit, that humanity will rearrange its economies to do so. And just sort of a gut feeling as sort of a conjecture of how the economy will work. That has held true for several decades, and certainly since Kurzweil wrote his famous The Singularity is Near book, which if you haven't read it, I'd suggest you buy it and at least read the first chapter, after which you will probably put it down and go for a long walk. The nuclear renaissance will be driven by the need for super high quality baseload power that only nuclear power can provide. Now, expressing that view, the easiest way to do it, just get long uranium, I suppose, the Sprott Physical Uranium Trust. There are other companies in the space. The nuclear industry is notoriously difficult to invest in because it's been overlooked for so long. Sprott also has an ETF, which combines a basket of uranium companies as well as some exposure to the Sprott Physical Uranium Trust. I believe it's UNRM is the ticker. I would take a look at that, but do your own due diligence and all those things. I think there's significant tailwind in the nuclear sector. Physics will ultimately not be denied, and you cannot grow electricity capacity without a substantial nuclear renaissance. And we're seeing that today, and full credit to the Biden administration for recognizing that fact, and we think trying to get ahead of it. Although we would say the recent passage of the uranium import ban from Russia seems rather risky. Certainly bullish for uranium and the whole complex, but we shall see how that will work out.
Doomberg, I've said when physics and feelings collide, physics always wins.
Yeah, physics is undefeated in the battle against platitudes. That is our preferred expression of that same feeling.
Perfect. That's perfect. That just answered John Ayer's question, who wants to know nuclear growth long term in the U.S. I think you just answered that. Here's one from Paul English. Doomberg, won't the U.S. fiscal quagmire brought on by unrestrained spending along with the Fed and Treasury moves eventually drive the market for hard assets, PM's commodities, including oil?
Yes. Well, I mean, there's no other way to say it, but it's just a matter of timing and your own horizon, right? So our narrow analysis of between now and the U.S. election is different than 10 years from now. I mean, we are clearly on an unsustainable path. I mean, $1 trillion every 90 days in the U.S. Debt pile. Nobody believes that's going to be repaid. I mean, we're at the refinance, kicking the can down the road stage of the fiscal dominance crisis. And I think, again, it boggles the mind that we're like, going around the world picking fights with nuclear superpowers when we're running massive deficits and accumulating debt that nobody believes we'll ever pay back. But it is what it is. Again, like in the medium term, absolutely terrible. I mean, we see a crisis coming. In the short term, I think we'll be able to extend and pretend and punt it down the road and get through the election.
AJ Steininger. So, would this scenario you were describing be bullish or bearish for oil refiner stocks? What of the refiners based on this thesis?
Sure. Refiners are a little more complex because you're one step down and China has excess refining capacity. Well, for all the talk about China importing oil that exports a lot of finished goods, China has this way of occupying critical choke points in supply chains that make analysis like this a little bit more tricky than just the headlines would allow you to believe. I would say the most valuable thing to have is a grandfathered permit to operate a refinery in the United States. Like we're not building anymore. We occasionally expand, big sites if the government allows you. But I tell you, if you own a permit to operate a refinery or a chemical plant or other major heavy industry in the United States, that is extremely valuable. And we don't know how to build these things anymore, and we just don't. And so, what we're seeing, even nuclear power, these plants, we had Mark Nelson on and recorded him for our Doom Zoom Pro, which we'll release in a bit for May. The nuclear power plants are basically immortal today, and these chemical plants, these refineries that have permits that nobody wants to see shut down, and environmentalists occasionally complain about, if they have the permit and they're there, that's a license to print cash for a very long time. And so, by and large, over the cycle, refining is a pretty good business.
Doomberg, I have to say, this 30 minutes, you've absolutely crushed it. I don't think I've gotten this unignorant this fast in 30 minutes ever in my life about energy. This has just been a fantastic conversation. Come back and do a deep dive with me, man. I would love that.
Anytime, you know how to find us, and I really enjoyed it. And I must say, Ash, I again crossed this off my bucket list. Real Vision Daily Briefing with Ash Bennington. Maggie, love Maggie too. So, but happy to have participated with you today, and I really appreciate the questions from the audience. And Doomberg.com if they want to find out more.
Doomberg, before we go, final thoughts, key takeaways. We covered a lot of ground here. What would you like to leave folks with?
I keep an eye on the price of gold and the price of oil as it pertains to the Middle East. That is the one thing on the board, and I do think people are perhaps underestimating the seriousness with which Russia is taking all this talk about NATO troops in Ukraine. Totally underreported story is that Russia called in the ambassadors of France and the UK yesterday and basically gave them a pretty severe dressing down. We'll see what happens in Russia. I think we're going to lose the war in Ukraine, and the big risk on the board is NATO's response to losing that war. And I don't want to uncork a whole can of worms here in the last 30 seconds, but keep an eye on Ukraine, keep an eye on the Middle East. And if peace were to break out there, then I think oil goes down, commodities, stocks go up, everybody cheers. But just keep an eye on those two things because those are unpredictable. We're one misunderstanding away from $120 oil. I don't want to be like totally bearish oil. The geopolitical risk premium is there for a reason. It could go both ways. The way in which it resolves will be determined by factors that have nothing to do with the physical supply and demand of oil.
Spectacular conversation, Doomberg. Really enjoyed this one.
Thanks, sir.
Before we go, Raoul Pal has said the economic singularity is coming. We have 6 years to make as much money as possible in Raoul's view. If you want to hear more about Raoul's thinking on this, get ready for The Exponentialist. Start with your $1 trial today at realvision.com/The Exponentialist. That's realvision.com/The Exponentialist to get more of Raoul Pal's views on all things future. Thank you so much for watching. Thank you for listening to Real Vision Daily Briefing. We'll be back again tomorrow, same time, same place. See you then. Have a great afternoon, everybody.